Most startups will fail to raise venture capital because they're not tracking the right metrics. So, if you're a startup looking for funding, you have to be tracking the key metrics of your business in order, number one, to make sure that you're hitting important benchmarks, but two, so that when a venture capital investor asks you for those metrics, they are right there and readily available for their review. But what are those metrics? How do you know whether or not you're hitting the correct benchmarks? And how do you go about showing that to a venture investor? My name is Matan Hazanov. I've been investing in venture capital for over 10 years, have been a part of over 30 startups as an investor, deployed tens of millions of dollars in venture capital, and helped companies get to 9-figure valuations. These are the 4 metrics you should be tracking as a startup, but all these metrics are important in one way or another. Now, a caveat. Every metric has its nuances and limitations, and there are no hard rules regarding any of these metrics. If you have excellent metrics, that's great. But if you're lacking 1 or 2 of these metrics, that doesn't mean you won't be able to raise venture capital. These are just a guideline, and they will change depending on what kind of business you're running, what industry you're in, what geography you're in, and most importantly, what stage of business you're in. If you're a pre-seed startup with no revenues, then most of these metrics are not going to matter. But if you already have a product in the market, have a few $100,000 in revenues, then it starts to matter quite a lot. And especially as you get progressively more down the road and down the cycle of building a business, these metrics will matter a lot more. So with those caveats out of the way, let's get into it. The first metric is gross dollar retention. This metric tracks how much revenues you kept from existing customers. So you take customers at year 0, take a random year 2023, and you have a certain amount of revenues for those customers. Now, how do you track gross retention? Is how much of those revenues you were able to keep in 2024 from those exact same customers. So you track churn, but you don't give any benefit to upsells or expansions from those same customers. For example, if you have 10 customers, each paying $100, that's $1,000 in revenue. Let's say 2 customers drop out completely and 2 customers double the amount they're spending with you. So technically, you're still making $1,000 from the same set of customers, but your gross retention will only be 80% because you're counting the churn, meaning the customers that have left, but you're not counting the upsells and expansions. This is the harshest way to look at retention, but it's very important. Why? Because what investors are looking for when they're looking at this metric is what is the quality of the logos and customers you have today. So for example, I've seen some extreme cases where you'd have one customer expanding a lot, but many other customers churning. So that indicates fundamentally that there's a lot of customers in the current pool of customers in the business that aren't a good fit. And here's a formula. As you can see, you take your starting ARR or revenues minus the churn and divide that by the starting ARR or revenues, whatever you're tracking. And what's the benchmark performance for gross retention? In software land, it's roughly 90% or up. That is top tier performance as a business. The next metric is net dollar retention. It's very similar to gross dollar retention, but in this case, you get to take into account upsells and expansions within that customer base. So let's take that same example. You have 10 customers, each paying you $100 a year. Now you have the same situation happen. 2 customers leave and 2 customers double their use. You're still at $1,000 in revenues from the same set of customers, but you've lost 2. Now in this case, your net retention is going to be 100% because you've kept all the revenues from the same amount of clients and you're giving yourself the benefit of the expansions and upsells, unlike in gross dollar retention. And this metric gives you a lot of insight into the quality of revenues as a whole. You want to know that there's something going on correctly about the sales, the marketing, management, customer service, upsells, and how net retention and gross retention play off one another actually gives you substantially more insight into the business. For example, if you have high net retention but low gross retention, which is possible, that usually means that there's a lot of money wasted on marketing efforts that are bringing in customers that aren't a good fit. So what you should do in this case is actually do a cohort analysis. You look at where your marketing spend is going and you look at the churn based on the different strategies or the different types of customers you're targeting to try to identify where your marketing is going wrong and bringing in the kinds of customers that are churning too quickly. This also can indicate a problem internally, such as customer service. So you want to look at your customer service teams or your upselling team and see why a lot of customers are leaving, but some customers are growing. And top tier performance for a customer and the benchmark performance for a startup or really for any business is over 100% in net retention, meaning that from the same base of customers, you're generating more revenues every year, which is an indication that there's constantly products and features being added and that you could expand the revenues from your existing customer base. It's much easier to sell more products to the same customers than to get a new customer. And lastly, the formula for this is starting ARR minus churn plus upsells and expansion divided by by your starting ARR or revenues. The third metric is your lifetime value to customer acquisition cost ratio. This is a complicated one because it takes into account multiple formulas, but we'll try to simplify it here. What is this ratio? This ratio at its core is how much money do you spend relative to the value of that customer. In short, this metric is the value of each customer relative to the cost of acquiring the customer. So let's say you're spending over your entire business or cohort, however you want to look at it, you're spending $1 in customer acquisition and you're making on average from that same cohort $2 from that customer throughout its entire lifetime. Your LTV to CAC ratio is going to be 2 or 2 to 1. This is an important metric because it provides insight into the overall quality of sales and marketing. What you want to see here is a very high ratio, meaning if you're putting in $1, from that same dollar, you are generating much more revenues over time. So what investors are looking for specifically here is that if they're giving you money to invest in sales and marketing, and those dollars are going to have a high ROI on generating new business. And if there's a low ratio relative to what's expected, that usually means there's a problem in sales or marketing. Either you're spending too much to acquire customers or you're targeting the wrong type of customers, but it's an indication that something is wrong. It could also mean that there's high churn because part of this calculation of lifetime value takes into account churn. So this is kind of an overarching ratio that takes into account multiple parameters and gives you quite a lot of insight into the business. And as an entrepreneur, frankly, all these metrics you should be tracking for yourself and to be able to monitor what's going on in your business. And the formula here, again, it can get a bit complicated, but we're going to simplify it here. You take the average value of the customer. You have to take, that's a separate calculation. You can find a link down below to find how to do this. But in short form, once you already have the lifetime value of the client, you divide that lifetime value by the total cost of marketing and sales over that period of time. So let's say you take 2023 or 2024 Q1 or Q2, whatever. You take all the customers that you've acquired from that cohort, and then you divide it by the cost to acquire those customers, right? Taking into account time and sales, going to conferences, whatever it is, and that's going to be your ratio. And the benchmark performance is over 3, meaning every dollar you spend in sales and marketing should generate at least $3 in revenue. And the fourth and final metric you should be tracking as an entrepreneur looking to raise money, and frankly, even just for your own business, is your burn multiple. This burn multiple was coined by David Sachs at Craft Ventures. It's one of my most popular metrics. It is effectively a metric of capital efficiency, which is very important for investors. It should be important to everybody, but VC investors like to look at this especially because they want to know how well you're managing money. And at root, it's basically how much money you burn to attain a certain amount of revenue. So the theory behind this is that a company that took $10 million to generate $1 million in revenue is worse than a company that only took $5 million to generate that same $1 million in revenue, all else being equal. And what's the formula for this? It's your net cash burn divided by your net new ARR. So you take all the cash burn in the business after sales and after getting more revenues and everything, your total cash burn, all the money that left your business to continue operations, and you divide that by all the new ARR over a given period, usually in a calendar year. And the benchmark performance for this is 1.5 times or less. So just to understand how this works, let's say you have $10 million in total cash burn and $2 million in net new revenues over that same period of time, your burn multiple will be 2. You want to be under that. You want to spend, the best is when you have 1-to-1 or less than 1, meaning that if you're burning $1 million, you're generating more in net new revenues. There are plenty of metrics as a startup, as an entrepreneur, depending on your industry that you need to track. These 4 is just the first step. You have to develop the internal systems in order to track these consistently in your business, make it easier for yourself. Create those systems internally. Use these metrics as a way to measure yourself and your team. Hold you and your team accountable to deliver on these metrics. And when you go and approach venture investors to invest in your business and you have them readily available, and for sure if you meet these benchmarks, great. But even more important, if you don't hit these benchmarks, you know why. You can explain to the venture investor, the VC, why you haven't hit them. Again, you don't have to hit every benchmark, and it will change and the benchmarks will change depending on which industry and stage and geography you're in, like we talked about. But what's important is that you have these metrics readily available and that you know when you're not hitting them and why. For example, if you have high gross churn, you have to explain maybe you had a set of customers that you targeted initially that weren't the right fit, and now you learned your lesson and you're targeting a better set of customers and you have high net retention. That's a great story and it could work, but you have to know these metrics in order to tell that story. So that's it for today. Thank you for listening. My name is Matan Azanov. If you like this type of content, you want to learn more about startups, venture capital, all that fun stuff, like and subscribe to this video, leave a comment down below, let me know what you thought about this video, and I'll see you in the next one.